Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. The market looks like it's going to close lower for the fourth consecutive week, and the Chicken Littles of the world are calling for a market crash. I'm going to make the case that we've already had a crash. It's just the indexes don't know it. But as the storm clouds roll in, like a sailor who checks which way the wind blows, I've been noticing a potential disturbance on the horizon for next week's OpEx. And speaking of bad forecasts, when it comes to Tesla, I just might have the last laugh. All that and your questions, and to help me out with today's show is my co-host back from his whirlwind tour, Mr. X. Hello, Thomas.
Hello, John. How are you, buddy?
Hey, I had a nice little finish this week. You know, a couple of little stocks that we looked at last week did well, so I feel vindicated.
Yeah. It's been an exciting week. As you mentioned, I had a long flight back home to the States yesterday, so I'm still trying to recover, John. So if I have a slip of the tongue or if I fall asleep, try not to hold it against me, guys.
Yeah, don't fall asleep on me, buddy. I don't need you to do that.
All right. So just a reminder for everyone watching directly on our website, if you want to ask a question, just click Ask a Question at the top right. You'll see it in orange. If you're watching on YouTube, go ahead and ask those questions directly in the chat. And John and I will get to as many as possible. All right, let's jump in. So, John, all the major indices have now officially entered a technical correction, meaning a decline of at least 10% from their recent highs. But, John, a funny thing happened. 2 weeks ago, nobody believed we could possibly have a correction. And now people think that we might be headed for a bear market. I'm seeing a lot of talk about that on social media. So it got me curious. And I ran a poll, John, and 63% of respondents believe we are headed for a bear market. So basically another 10% drop, at least in the case of the S&P 500. So John, are you with them, or do you believe the pain is already behind us?
You know, that's a great question. I do think that that's kind of a sentiment indicator, which could be a contrarian indicator for us as we go through today's show. But you know, what I feel like the market has done is it just woke up and we're just seeing a margin contraction here, or a growth contraction, and that just the indexes haven't already seen it. So when when we see one of these events happening and there's a lot of noise around them, we get a little nervous about them. I think it's always good for us to take a step back and look at the market from a big picture. So, let me look at my chart here. So, here we are at the weekly level. And, again, I want to kind of just look at this from a big picture. And I'm looking at this in terms of, let's say, a trend line, right? Certainly, I think since the October low, can we make the argument that this trend has been broken? Yes, I think that we can make that argument. But if we even go to a bigger picture, I think more what we're seeing is that we're in a correction mode. We're not really making a new lower low, right? We're just kind of not moving forward and maybe pulling back. So again, my theory is that, yes, we've had a 10% correction in the indexes. And this is one of the things that I've always said about the indexes. I think the indexes are kind of misleading because of this high concentration of the Mag 7s. It's only the Mag 7s or the top 10s in these concentrations that are now finally giving up a little bit to the downside. But here is the S&P 500 constituents, right? And I'm under the performance section of it, and I'm going to sort this here by 52 week, right? Where are we at the 52 week? And look at these names, right? These are not like small caps or medium caps or unknown companies. These are big companies. Whoop, up, refresh. Refresh. There we go. And one more. There we go. Right? 60%, 50%, 45%, 30%. These companies have already crashed. Now here's the tech heavy NASDAQ, again, let's look at from a 52-week perspective, right? 40%, 30%, right? And, yeah, that's like it's tech heavy. But, look at like a name like Old Dominion. That's a transportation company, right? Down 23%. So my theory is that I think the market is already in a bear market. It's already had its crash. We just need that capitulation in the indexes to kind of give us that guidance that now maybe things will get better. Certainly, we could look at things like the breadth, right?
Yeah, exactly. And John, one of the things I posted about on our X account was the fact that the market breadth was falling off a cliff. In fact, yesterday, John, just 1/3 of S&P 500 stocks were actually trading above their 200-day moving average, which you can see on the chart in front of you. Now, if you guys are using bar chart and you want to look at the breadth, you can use that special symbol. You see it in the bottom pane, which is $S5TH, which will give you the number of stocks above the 200-day. So, John, do you think that the fact that this fell to just 1/3 of stocks above the 200-day, is that concerning, or do you think that it needs to get even lower for it to become a really big problem?
Yeah, I think in this one, this is that kind of that sentiment indicator is if you look at um, where you see bottoms or where you see where the market stops going down and starts going up, at least very technical bottoms. I think we need to get even lower on that number. I think something below 20%, maybe, you know, 15 or 10%. I think that would be that bottom that we would need to see. Again, that could be a little bit lower from where we are in terms of the indexes. Maybe a lot more of the companies that I just showed you, we need to get some of those companies to go down another 5 or 10%. So yeah, I think that's what we need to look for, those conditions, and then we can go and look at the particular individual indexes. Now let's go back to the S&P here, and let's go back to my chart, Thomas. And so again, we're only down about 10% on the S&P here. And let's kind of look at the 200-day moving average, right? Because we always say that nothing ever good happens on the 200-day moving average. So I would like to see the market crawl out of this low and recapture the 200-day. I don't want to see a quick rally. Like today was kind of a quick rally, but this is just the first green candle that we've seen in a while. What I would like to see the market do is crawl out, regain the 200-day, and then move higher. If it just does a quick V bottom, then I think this is just going to be on like an ABC, and I think we'd still need that capitulation in the indexes to the downside. And again, let's look at the Qs, same kind of thing, right? We're still below the 200-day. So, and these levels, both of them, the 200-day, were also those levels of confluence that we had saw in our Fibonacci numbers, and they were also technical support levels that we broke. So now they become technical resistance levels. So all these things are converging together. So this is kind of a ceiling that it's on top of us that we need to get above. Again, I really want to see that market kind of, move out. Now I want to show you one more thing, Thomas, before we move on to the next segment, because I don't want to go too long on this one. And this is where I'm kind of thinking big picture again. So what are we looking at? I know this is kind of messy here, but what are we looking at here? So this is a Bollinger Band weekly chart. The blue line represents the 40 weeks, which is similar to the 200-day. Again, notice where it's falling in that area of where our Fibonacci's were in line and our structure, our former structure. And our Bollinger Band is now turning out. Now, below here is a black line. That black line is a 55-week moving average. And so it's very difficult for the market, or, this is like an ocean liner or a cargo ship. It's very difficult for this moving average to turn. It takes a lot of negative energy to turn it. And so we're kind of seeing that. So, they got the Bollinger Bands are turning out. That's telling us more volatility is coming in. If the Bollinger Bands were super wide and we were outside the Bollinger Bands, then I would think a pullback. And I certainly think the market is oversold. And I do feel that there might be a little bit of a pullback or drawback here, pullback into the market. But the bands are moving out, and that tells me more volatility, and that tells me that what we might be seeing is the beginning of either a major correction or a little bit more downside before we see upside. So just keep that in mind. And again, here we can see a 13% correction so far in the S&P. So I'm waiting for that catalyst for that final capitulation, right?
Well, John, that's interesting observation because next Friday we have a very big event taking place, and that, of course, is triple witching options expiration. So, John, do you believe that could be the event we need to actually get that final capitulation, that final sell-off?
Yeah, that's exactly what I think is going to happen. At least that's the game plan that I'm kind of looking for. So let's start here. So I'm in the S&P, the SPY ETF. And first, let me go here. I want to go down to here. Let's start off with the put call ratio. And so here we can see that on the monthly expiration, the quarterly expiration, that's what the triple witching is. That's when the stock options expire. That's when the index options expire. And that's when futures expire. So that's why they call it the triple witching. So you can see here for today, look at the put to call volume, right? It's 2-to-1. And look at the open interest. It's 2-to-1 or greater. So what we're seeing is the market is setting up with a lot of insurance, a lot of hedging of puts. Now, if we go to the actual market and look at where these puts are strung out, right? We're talking about multiple months now that these positions are being built. A lot of them are way above. Well, I don't have the right strike. Excuse me. A lot of them are in the money. Some of them are deep in the money. And what I noticed over the last few days is that notice that all these in the money puts are not being rolled down. Notice there's not a lot of volume in these, right? That the folks are going to hold on to these puts. Normally, what they do is they probably would roll down. They take the profits and roll down. But at the same time, look at the volume that we're starting to see in some of these downside strikes, the 540, right? Almost 100,000 volume today. And it'll be interesting tomorrow to see if this open interest rises. I think you will see that. Look at the 530. Again, we already had 130,000 volume open interest and another 60,000 today. So again, what happens now is the market maker has to hedge these. Plus, they already have the hedges that they have from the previous puts, but those puts are going to be exercised. So that means that puts pressure on them as well. And this is called a negative gamma. So I would not be surprised that during the week, next week, the market maker will try to hold the market up and make a lot of these puts out of the money, but the pressure will be too great for them. And that the way that they have to hedge that is they have to sell, and then it becomes kind of this snowball event. So I think that's what's going to happen. This triple witching hour is going to give us a capitulation move to the downside. Now, where could that downside be? Well, if we just have a 3 to 5% move in the S&P, right? That's about, for the SPY, that's about 20 to 25 points. Well, that today would put us in between the 540 and the 530 level. Now, let's go back to our chart. And again, I'm going to go to a daily here so we can kind of look at this. And I put those two strikes down. There's 540 and 530. Now, this black line represents another layer of Fibonacci technical support that we already looked at last week, and if I measure that from the all-time high, Thomas, look where that puts us at a 13% correction in the market. So to me, Volmageddon, triple witching hour, capitulation, bottom striking. That is what I'm looking for next week.
So, John, if it did play out that way, would you then be a buyer at that level?
Yes.
Okay.
Again, I think the things that I want to do is I want to have a list, a checklist, or a watch list of companies that I want to purchase. Or remember, we talked about where we might be in the market cycle and which sectors we kind of want to start nibbling in. And certainly we looked at some of those sectors last week, and that we were already starting to see the market rolling into those segments and sectors.
So, John, one of the concerns that I'm hearing a lot more about lately is the idea of stagflation. Now, that actually got me thinking because Jamie Dimon, CEO of JP Morgan, late last year said that he was worried about stagflation. He thought it was one of the biggest risks to the market. Now, this was in September of 2024. He said this, John. It's taken a while to play out. Now, some of you may not be familiar with the term stagflation, which is continued high, persistent inflation combined with stagnant economic growth, one of the worst situations that an economy can go through. So, John, I guess the question for you is, if we do, in fact, enter a period of stagflation, are there any good investment opportunities where we can look to deploy our capital?
Yeah, I mean, be honest with you, not really. But yes, I think we can have a defensive position where we could be in certain sectors or individual stocks that could, let's say, bear the brunt. So what is stagflation? Like you said, inflation and slower growth. So what we want to look for is domestic companies that should be able to withstand that inflationary pressure by being able to pass along the pricing to their customers in depending if the demand for their products or services. And again, their demand has to be inelastic, and they're immune from that in recessionary pressure, right? Again, that elasticity of the demand for those goods. Plus, they are buffered from, because they're domestic companies, they are buffered from the potential of whatever is going to happen with the tariff situation. So, kind of for S&Gs, if you know what that means, I put together a list here of companies that I think we could kind of look at. Now, remember last week we pointed out that in the sector rotation, I don't really want to talk about where we are in the economy because I think we could have a long debate, but I just look at the market, right? The market cycle. We've come from a market top. We're in a correction or a bear market, depending on how you want to look at it. So energy staples, healthcare utilities, and financials. And then in financials, in the defensive aspect, we can also talk about REITs or the real estate sector. So here's my watch list. And so what I did was, and again, I went in those sectors and I really just kind of just find the best of best. So I kind of drew a line where I said, hey, I don't want to look at companies that have a trading PE ratio of greater than 30. Oh, there's a couple here. For instance, waste management. The only reason why I put waste management in is because I think the waste management business is recessionary proof. It's just that this one had the cheapest valuation of all the major waste management companies. But so you can kind of see them. The other one that I thought was kind of interesting I put in here is Berkshire Hathaway. Why? Well, first of all, that stock did not even flinch this week. It's knocking on its all-time highs. And remember, Buffett's sitting on $300 billion in cash. But let's flip this around. I really kind of want to start looking at some of those companies where I'm going to get a good dividend defensive, right? And, maybe their PE ratio is, let's say, in the mid to low teens, right? And so you can see some of these companies here, Verizon, Kraft Heinz, in recessions, people drink and smoke. It's a studies that they drink more and smoke more. So you got cigarettes, you got beverages companies. Full disclosure, Archer Daniels is in my portfolio. It's one of the companies that I have, and you guys know from last week, Energy Transfer as well is also in my portfolio. So you can see some of these companies, and again, this is a mixed bag of energies, consumer staples, financials, and real estate. And in the real estate segment, I have like companies that are in the apartment or single family homes business that are in some areas where maybe the price of homes have gotten too expensive for folks to purchase them. So they're in the apartment, in the renting business. I don't want to get into the real estate of, let's say, commercial real estate. I think people still need homes to live in. And if they can't afford to buy one, they're going to rent one. So a lot of these real estate companies. So again, if you want to take a screenshot of this, so here's the top. There's about 45 in here. Here's the bottom 20. And then I'll flip it around here. And there's the top 20. Okay. So that's what I'd be looking for, Thomas, those particular companies.
Okay, so John, people who have been following us for a long time, they know your two favorite investments are, of course, Tesla and Bitcoin. Now we're just gonna focus on Tesla right now. And the reason we're talking about Tesla, John, is it's kind of going through a rough patch. The stock price has just been getting absolutely killed. And some news earlier this week didn't help, John, and that is JP Morgan. So JP Morgan cut their price target. It was already at 135, John, which is not a great price target for if you're a Tesla bull right now, but they actually lowered it to 120. Now, here's what's interesting. On the same day, Morgan Stanley came out and they maintained an overweight status as well as their $430 price target. So, John, the question for you is, which of those two is the most likely? And I want to give you a small piece of information, John, before you answer that question. Jim Cramer's bullish on Tesla. So do with that what you will, John.
Yeah. Okay. So, well, first of all, I'll tell you what, I know who's long, Morgan Stanley, and I know who's short, JP Morgan. Okay. So about a year ago, maybe it was a little bit longer, maybe it was about 16 months ago, we did an exercise and we talked about market cycles and different cycle lengths. And, I kind of did a market cycle on Tesla. And, I came out with this saying that, hey, I saw that there was a market cycle and it looked like the market cycle was going to make Tesla bottom in March. Now, at that time, Tesla was trading like around $150. And so I put my neck out there and I picked the number, which was $68. I said, if the market bottoms in March, I think we could go down to $68. And I tried to make a case for it by coming up with a few points. And so those points were, that I thought that this was a maturing tech company. And it was arguing that it's just a car company that had flat growth, that it had declining margins, and that it had flat revenues, and that it had increased competition, especially in China, where China is incentivizing EV buyers of domestic EVs and not Teslas. And, Tesla is a great car, right? And there's no obsolescence to it. And so people are buying Teslas or holding on to them. And the final piece that I said was that Elon's political stance would clash with his culties, the green EVs. And I called that genius premium, what Tesla has been holding on to for a long period of time. And so what I think the market has done is it's recognized that this is just a car company right now with a very extremely high multiple, and that we need to get back to more of a realistic multiple. And I'm not talking about peers. I'm not talking about automaker peers. I'm talking about a realistic multiple for just a tech company. So, we're at 120. I'm talking like 40, 50, I don't know, 60. That's still a 50% haircut in terms of the multiple, which here we are at $250. That's where I think JP Morgan gets that number, right? A 50% haircut in the multiple is a 50% haircut in the stock price. So again, let's go back to the chart and we look at big picture here, right? It's not too long ago we were trading around $150. I mean, we're only talking about a little bit more than a year ago. And if we look at this in terms of a big picture, this looks like a giant double top, and now we're falling to the bottom end of a trading range. And if we fall below the bottom of that trading range, then I think that 135 level is a good level. But again, I still might get the last laugh if something drastic happens in Tesla and get that $68.
Now, John, I've certainly been more bullish on Tesla than you have. I have a small position, just full disclosure. Now, we talked about this yesterday, John, in our planning session, but I said, a bull's argument they might say to you, John, is, man, Tesla has just been getting raked over the coals lately, just bad news after bad news and hit pieces and all sorts of different things going on, John. So they might be saying, John, well, how much more pain could we face? It just feels like we're already facing so much. What else is there? Isn't the bad news already priced into the stock?
Well, don't they have their earnings coming up soon, right? I think they do earnings late, April 22nd. Again, I think it's just about revenue. I think it's about number of units sale. There's a lot of talk that the sales in China have literally stopped. And then again, you get folks who thought he was a genius or believed in him are now looking at him in a different light. And so who knows what could happen with domestic sales. So I think that will be the key to tell us what the bad news is. But, on the positive side, Thomas, I mean, yeah, this is a tech company, right? We got robo-taxis and robotics and, they're in the energy space, they're in battery storage. So there's a lot of good positive, but those things might take time to play out, right? Only information that we have right now is Tesla, the car company, and a CEO who seems to be stuck in the quagmire of 100-year-old federal government bureaucracy. So, I think there's more pain to come.
All right. Good points, John. Good points. All right. So we've had kind of a downer show, John, talking about bearish stocks, talking about bearish Tesla, stagflation. Our viewers are kind of wondering, hey, guys, give us a little bit of hope for the weekend. Well, we've got some hope, guys. John, gold has been one of the hottest assets that you could possibly own, just going up green day after green day after green day. And we've talked about gold a long time, John. We've said that we were both bullish on it. We believe it's headed for a secular bull market. And I saw this headline, John. This is coming from Macquarie. I don't know if I pronounced that correctly, but they say gold is going to go as high as 3,500 an ounce, John, in the third quarter of this year. In a show we covered, I believe, about a month ago, John, we said Goldman Sachs believes gold is headed to 3,100 this year, maybe as high as 3,300. So it's feeling like a lot of people are bullish on gold, John. And my question to you is, are you a $3,500 level of bullish on gold?
Again, you made a good point in our production meeting is, people forget how big this asset class is. And, that's a huge percentage movement. So I think 3,500 is out of the realm of reality, but I certainly think I can make a case for 3,100 or 3,200. We're kind of knocking up against this 3,000. I think that's going to be a psychological barrier for the moment. And I don't think the number 3,000 itself, I think we'll probably bounce around it, up and down above it. But I do believe that we're going to get above there, eventually get above there. And, one of the things that we looked at is a chart of the GLD. And again, we picked out some targets based on fib extensions, and we got to the first target, then we based at that target. Now we're setting up to get to this near-term target. That is right around the 3,000 level if we translate it into gold prices. But objectively, we said that we thought that the GLD by the end of the year would get to around 295, and you can see right that 295, 297. And so if we turn that into a dollar price of gold, then that would be around $3,200. Now, I want to kind of show you guys something first. Is what I love when these guys come out and say, "Hey, gold's going to go to 3,100 by the end of the year," right? I always laugh at that because all you got to do is go to the futures market, and the futures market has a great way of predicting where prices are going to go. That's why it's called the futures market. And you can see that the December gold futures contract is already at $3,100. So I don't think it's out of the question that we're going to see 3,100. It's just, do we get to 3,200? Now, here's the caveat. If we go into a recession and we have kind of this stagflation thing, the resulting effect to come out of stagflation and out of recession is a deleveraging or a deflationary aspect. So a lot of folks think that, when the stock market goes down, the gold market goes up. Yes, that happens. But gold and stock market have a higher correlation, positive correlation, than they do an inverse correlation. So if we have a dramatic down movement in the stock market, again, I risk off deleveraging. Gold is a risk-on asset. I know it sounds like a lot of people think of it as a safety asset, but it really is a risk-on asset. Then I think gold could have a correction in it as well. Now, what is interesting, and I just did put this up, we're making new all-time highs gold to dollar. But if you look at gold to other currencies, they've already made a big move, and they're kind of languishing here. This is the gold to the Swiss franc. And if you look into the euro, same kind of scenario. So there is a cautionary here. We really kind of need to see gold really break out above 3,000. And we really want to see the strength in other currencies, gold to these other currencies, not just gold to the dollar. This might just be a gold to the dollar, as the dollar has weakened. We looked at the dollar a few weeks ago. So, if the dollar falls back to 100, then that could be the impetus to push gold higher. But in the global market, it might be a topping signal.
So we had a question, or not really a question, just a statement. This is from Jim Van Meerden, bar chart contributor. John, you predicted he would be in attendance today. He actually is. He's always in attendance.
Hey, so Jim.
So John, his statement is, he says gold is a constant. It does not go up or down. The dollar goes up or down. It takes more dollars to buy an ounce of gold or less dollars to buy an ounce of gold. What do you think about that, Jim?
I think that, he hit it on the head. I always believe that when you look at gold, you have to look at the dollar, and that's where you're going to find the direction of gold, right? This kind of this devaluing, fiat currencies. So, again, if you wanted to look at the Dixie, right? Again, if the Dixie is starting to turn or finding a near-term bottom, that's going to be a headwind for gold. We really kind of need both, right? We really need the dollar to fall back below 103. That would be then impetus to push gold. But I think, like Jim says, over the long run, I certainly do believe that there is more upside to gold than there is downside. My only concern is if we do get into a reflationary, deflationary, end cycle, that gold will suffer just like other risk assets, like we've seen. For instance, I know my other favorite market, which is the cryptocurrency market.
You can't stop talking about it, John. I think I agree with that in the most for the most part. The only caveat I would say is if you look at a 2-year chart, for example, and you look up Dixie versus GLD, the Dixie is up and so is GLD. It's just up a heck of a lot more than the Dixie. So yes, if the Dixie rolls over, that's going to help gold, I think. But gold has been strong on its own, John. You cannot take anything away
No,
from
you
GLD
can't.
over the last 2 years.
And I think what's happening in this last little impulse is it's really a reallocation of assets, right? Money is coming out of the stock market, and it's a diversification of a portfolio, right? People look at gold as a safe haven in times of distress, right? And certainly we feel a little bit of distress. So I think that's kind of that emphasis that is kind of pushing the current gold prices. My concern is when you look at gold in relation to other currencies, you're not getting that emphasis. That's probably because a lot of monies, that was in the U.S. stock market is now coming out and going into the gold.
All right. Well, I think that wraps up our main subjects for the show, John. Are you ready for some Q&A?
Q&A me away.
All right. So somebody wants to know, John, if we track options trading from insiders. And yes, we do. I actually think we added this fairly recently. But just to give you guys an example, if you go to the Politician Insider Trading page, and then you click on Nancy Pelosi's name, John, you'll see it on the right side there. You will see that Nancy is a prolific options trader. So it lists all her different trades. Looks like she's got some with Amazon and Google. But that is a way for you to go and check and see what insiders are doing with options trading.
Right. We can't sort by options alone. We have to go to the individuals, right? Is that correct?
That's correct.
Okay. It is interesting, though. Look what she's recently bought. Talk about maybe some stagflation. The reason why I did put, like, let's say Amazon or Walmart or Costco on that stagflation was because their multiples were too high. That's why they didn't make the list. But it is interesting that they're in there right now, or at least what she's buying.
John, do you have any tips or thoughts on when you would roll or wheel short puts that are in the money?
Well, I kind of have this rule that if I can get to like 85% of valuation, and I still believe that the market is going to go lower, that's kind of my go-to rule to roll. But other than that, sometimes I just, if I let the market tell me when to get out, and if it keeps going my way, why should I roll? What I might do is know that I have a certain amount of monies that I'm going to collect, and then what I might do is, knowing that I'm going to take in X amount of dollars, I might look to set a new trade with a small amount of risk, but based on the amounts of money that I've already collected or will collect, maybe take on a little bit more contracts, maybe take on a little bit more risk if I really believe in that trend.
John, do you ever look at AAII sentiment levels?
I do look at that, and I was actually thinking about bringing that up. I think we can just go right to the website. I know that it recently just got really it was really bearish. So let's see. I don't want to go seeking alpha. Where do I want to go? Here we go. And again, I think that's kind of part of your point that you look at market sentiment through the 200-day moving average. So yeah, it's extremely bearish, right? It's probably one of the highest indicators that they've had in a long period of time.
I actually put something out on our X account, John, which is that bears, the percent that are bears among the AAII sentiment levels, have been greater than 55% for 3 consecutive weeks. That's only happened one time before in history, John, which was March 4th, 2009.
Interesting.
So take that for what it's worth.
Take that for what it's worth. Yes.
John, is it good for bank financial stocks when central banks are cutting interest rates?
For the big banks, not really, because you think about big banks, they make a lot of money on interest income. So falling interest rates they lose that interest income. Um, but there is an argument that the cost of capital becomes cheaper, and then industries will be more likely to borrow money. So I think that's a give and take there. So I think it depends on the size of the bank, right, and who they're lending to.
Yeah, I agree with that. Actually, we've talked about unrealized losses. I posted this a lot on the X account over the last couple of years, John, which is the unrealized losses that are facing banks. Now, for a JP Morgan, a Morgan Stanley, that's not going to be a problem, but it is going to be a problem for small banks, especially if they face some capital control issues with people withdrawing and then they're not able to meet their other banking demands. So I
Right.
agree, for small banks cutting interest rates is going to be extremely helpful, and they're probably actually praying right now that the Fed goes through with that. But
Right.
JP Morgan probably just wants to keep things status quo.
Right, because the cost of money, they make more money, right? But yeah, you're
Exactly.
good to your point. If a small bank has a capital run on their bank, right? They're locked into those long term notes where they're going to get their principal back plus interest, but they have to wait for those maturities to come. So yeah, the lower the interest rates, that raises the net asset value of these long term notes. So they're basically losing. They're not losing money. They're just not realizing that loss yet. And
Um,
they won't realize a loss if they just take them to maturity. They're just stuck with them.
right. John, when trading gold, do you prefer gold bullion, a gold ETF, or a gold mining stock?
Yeah, we talked about this last time. Again, I think in this scenario, I think you need to be in the bullion market because you could get the um, miners could get caught up in the sentiment of the overall market. Plus, they have other costs, right? Insurance costs, labor costs, right? Fuel costs, right? Stagflation. So yeah, I think at this point, we talked about this last week. You want to be in the physical end, and I think if you really want to leverage it, then you got to trade gold futures. I showed you last week that you can get that 10-to-1 leverage trading gold futures, but futures and contracts are not for everyone.
Let's see. John, how much of the markets do you think are controlled and driven by AI programs owned by Wall Street?
90%, maybe even more.
There you have it, folks. Is it possible to see JP Morgan collars in bar chart? Not really. I mean, you could find that information elsewhere and then take it on and apply it in some fashion on bar chart, but we don't highlight what those levels are. John, is there a way to know the number of calls or puts being traded by market makers on bar chart?
Well, I get this question a lot, right? And um, just remember, every trade has two sides to it, right? You just don't have a buyer; you have a buyer and a seller. So pretty much a market maker is on the other side of, I would say, a very, very large percentage of every trade. Now, again, I might buy a call and the market goes up and I'm ready to take profits, and I might sell that call and you might buy it, Thomas. So there is a percentage there, but for the most part, you can make the assumption that every trade a market maker is on the other side.
Yeah, yeah, agreed with that. Now you can track options activity by going to our options flow page, and you can get an
Right.
idea of what's being traded, you can see what's being bought, what's being sold. But to identify specifically whether a market maker is the buyer or seller, I think is going to be a tough
Yeah, so for
challenge.
things like codes, I think I did a webinar on this about options flow, but you can look at these codes here. And so the codes sometimes can give you an idea of, is this an institutional trader? And then you can see how the trade played out. You know that most likely that way that trade played out, it was a market maker. In other words, if somebody reaches up and buys an offer, well, they're probably not buying a large offer from an individual. They're buying a large offer from a market maker.
So question, John, is that silver has had a good week. Do you think that strength will continue throughout the rest of the year and beyond?
Yeah, I think silver, as gold goes, so does silver, but I think silver kind of was languishing for a while, and for some reason I don't know why. Maybe because gold has gotten more expensive and people are kind of bargain hunting. It feels like silver is kind of catching up with gold. So yeah, I do think is if gold goes higher, so will silver, and maybe it might even in the short run outperform. I don't know the difference here, but we can look at that real quick. Go ahead, ask me another question. I kind of look that up.
Next question is going to be on your other favorite asset class, Bitcoin, John.
On Bitcoin?
Yeah.
I mean, again, I think it's more about.
Question is, do you think Bitcoin will follow gold into a bull market, John?
Yeah, I think Bitcoin has become a quasi sentiment indicator, right? I mean, it's reflecting the stock market, right? It had a nice up week this week, right? It found a bottom, short near-term bottom. It bounced off its 200-day moving average. All the things that we kind of have put together. I still believe that it needs to test a lower level and then pull back from that to give Bitcoin buyers confidence that they want to come back in here, right? This is kind of where they're afraid of being, right? I think Bitcoin traders are more bullish on strength than they are bullish on dips, but I could be wrong. So yeah, I still believe one more sell-off could come in the Bitcoin market. But again, what do I know about Bitcoin? So yeah, you can see my numbers here, and I'm going to stick to my guns on this one. So you got the 200 at 77,600. And I think there's a buying opportunity on a technical basis between 75,000 and 70,000. Did I lose you?
I was muted, John. So this will be the last question for the show, John. Do you think semiconductors, SMH specifically, have been oversold?
Okay, so full disclosure, I do have SMH options. And I have short vertical puts. And I've actually been on top of this one. And so, yeah, I do believe the market is a little bit oversold. But again, I think this might be just a correction, a small correction and a downtrend. You can see my numbers. I really tagged this one. I bought the 240s and sold the 220s, and it bounced right off the 220 level. So I'm kind of watching to see what happens. I'm still waiting for next week and see if we can come back to that 220 level. But again, sometimes when you need to take that step back and look where you are in the big picture, to me, I feel like this is a range-bound market, and there is still more room to the downside.
Hey, John, I got one more question, and it's because Wayne, our buddy Wayne, came in just in the nick of time, John. He wants to know if you have any thoughts, tips on rolling over options that have been underperforming.
Rolling over options that are underperforming?
Yep.
Wayne, take the pain and move on, buddy. Sometimes it's just, sometimes the best trade is no trade at all, right? All right, let's leave it at that, brother. Thanks, Thomas. Welcome back to the States. I'm glad to have you back.
Yeah, I'm ready for a nap now, buddy. Thank you.
All right, everybody. I hope you guys enjoyed today. Be careful next couple of days, especially next week. I think it's going to, we've talked about this. Volatility is going to be king this year, and And on these triple witching hours, you can see some big volatility. I mean, 3-5% type movement. So be careful next week. Until next time, the best of health, manage your risk, and the good of all trading.